This video is part of our portfolio series, and we're talking about REITs. During this short video, we're going to talk about what they are, how they can fit into a portfolio. We're then going to speak about the various sectors within the REIT space and the differences between them, and we'll finish with some fundamentals that if you are serious about investing in REITs, we feel like it's well worth it to get acquainted with these. A REIT is a real estate investment trust, and the investment is into a company that owns, operates, or finances real estate. The key here for an individual is that it makes it accessible to you. So you're able to buy a commercial property or a group of commercial properties, and the share in the REIT represents a fractional ownership in those properties. A couple key operating guidelines. REITs do have some tax advantages. In order to maintain their REIT status, 90% of earnings must be paid out to shareholders, and 75% of revenue must be derived from real estate. Now, as far as earnings growth can come from either rent increases within the portfolio or it can come by way of acquisition. Let's take a look at how REITs can be used within a portfolio. First of all, they offer diversification. REITs typically have a relatively high correlation with equities and stocks, but the things that move REIT prices do differ from the broad market. So whether that's interest rates, consumer metrics, or various pieces of economic data, your REIT exposure does offer diversification away from just a true S&P 500 type of equity exposure. Tax advantaged income, which we touched on briefly in the last slide. This is a key component for anyone investing in a non-retirement account. And then the other piece we want to note here is that while REITs typically first get an investor's attention due to their income potential, they do offer the potential for appreciation as well. There are a number of types of REITs. If you actually look at the commercial real estate market, it can be segmented into various categories. I'll comment briefly on what moves each of these segments within the REIT space. Start with hotels and resorts. This is a section of the market that's very dependent on a strong consumer. It's driven by both corporate travel and leisure travel, but we need to see strong consumer confidence. Typically, this is a sector that does well during periods of positive economic growth where GDP is expanding. Specialized really can't be lumped in terms of how it behaves because it has a variety of categories that can be unrelated within it. Frozen storage, for example, is one of them. Healthcare is one that is much more secular and is not based on cyclical growth. So healthcare, right now we have a long-term demographic trend where you have baby boomers that are retiring and need long-term care facilities at a growing pace. That's likely to continue for the next decade plus. Healthcare is being built out and senior facilities are being built out nationwide in anticipation of that demand. Residential, so when we're thinking about residential in terms of REITs, think about multifamily and commercial residential developments. That's what's going to be into this bucket here. Office space, this is your office building ranging from multiple tenants to single tenant use, nationwide, variety of sizes. You can have Class A, which is top quality offices in a large city. You could have the same top quality in a mid-size or suburban city trading at a different multiple than the most expensive cities. But office trades based on the quality of its location and the quality of the building itself. Last, just to touch on industrial, these are the warehouses that help get goods to the end user. So if you think about the boxes that are arriving on your front porch, there's a good chance the items in those boxes have moved through some industrial real estate. As we're filming this video in 2021, let's look at the impact of COVID-19 and what we just saw in 2020. That's going to give us quite a case study to see how some of these different areas were impacted. So hotel and resorts, we're seeing near high occupancy pre-pandemic. You had consumer confidence at a high, corporate travel was booming, and both of those, both the consumer and the corporate side, saw their travel plans cut close to zero. That was a major impact. Retail, same thing. You saw government mandates forcing retailers to close, and if the retailers close, that rent and that cash flow associated with that building is going to have a dramatic impact. Healthcare surprisingly saw an impact because you had non-essential medical procedures suspended and postponed for a period of time. So when that happened, you had a lot of doctors' offices and you had nursing facilities that couldn't get occupants through at the same time that we're seeing their revenues come under question. So healthcare did deteriorate. I'll comment on offices as another one here that really saw an impact. It forced companies to evaluate, is that office a requirement or is it a luxury? Is the price of that real estate really worth it for the company? We think many companies are going to be evaluating, and if they have 4 or 5 regional offices, they're going to be making some tough decisions on, is that really required, or can we lower our square footage, lower our footprint, and thereby reduce expenses? Time will tell whether that's a short-lived trend or a long-term trend, but we see companies reducing office exposure. I'll comment now on 2 that really fared quite well. So residential real estate and industrial continue to see growth through the pandemic, and as a result, capital moved in their direction. Some opportunities today. You could look at some of the areas that have distress. We have a vaccine that's currently being rolled out. If we get to a stage where we are post-pandemic, whatever that looks like, we don't know yet, but if the cash flows from some of the distressed areas do begin to look more stable and increase, then there's some opportunity for price appreciation along with some healthy yields on these distressed spaces. Meanwhile, if you're looking more for protection of principal and safety, you can stick to the areas that didn't see the deterioration and hence have a more predictable cash flow. Last thing I want to spend some time on is sharing some of the metrics that you should familiarize yourself with if you are looking to invest in the REIT space. So funds from operation, FFO, is similar to a PE ratio on a stock. It's a valuation metric. You want to look at what multiple to FFO is the company trading at. And I want to take that a step further and point out that you should use AFFO, which is adjusting for certain operating costs that it's reasonable to anticipate those costs will continue to be there. So AFFO is a more accurate representation of ongoing value. Net asset value, this is your total value of real estate minus any debt on the books to reflect the equivalent of a book value per share that you would find in a publicly traded company. In the real estate space, we're going to call that your NAV or net asset value. Last item here, cap rate. So your cap rate is going to be important to determining the market value of a property. And if a cap rate compresses, that means the cap rate's moving lower. The value of that building is going up as long as income is held constant. So ideally, you're able to purchase buildings at a high cap rate and sell them at a lower cap rate if you are acquiring and offloading real estate as part of your process. Now that we've shared information on REITs with you, we've talked about different segments within the REIT space, and then we finished by giving you some metrics to go do some further due diligence. We invite you to dive into this segment of the market, start to acquaint yourself. If you're interested in more about managing a portfolio or investing in general, we invite you to check out some other videos within our portfolio series.